This ain't easy, by the way. SpaceX speed, talking to Bloomberg's Danny Berger, doing all this at the same time. But the point is, you're exactly right, that the investors, our global audience, care about the economics of what SpaceX is doing. Starship can carry more stuff. That means that they can build out the Starlink constellation more quickly. That generates higher degrees of revenue. It gets them to more sort of solid ground on cash flow break even, and that funds the bigger picture goal for Starship, which is to carry humans to Mars in the long term, but in the short term to the moon in the first instance.
Well, there's this huge push for the moon, and Ed, we've seen that kind of be successful, kind of not successful in some cases. Last month we had Odysseus, that private U.S. lunar lander that, you know, yay, it lands, and then it kind of goes like this when it lands and collapses and doesn't quite work as planned. I mean, it's this huge space race, but this time it has the private bend to it. With each sort of venture like that doesn't go quite as planned, what does that mean? Again, in this time where things are speeding up so forcefully.
Well, SpaceX and NASA are intimately tied on this goal of returning humans to the surface of the moon, right? I forget the year. It's been an early morning for me, but it hasn't been since the 70s that we've really talked about this idea of getting humans back into space. The first iteration of that is a non-manned, a non-crewed attempt for Starship to land on the surface of the moon. And as part of the Artemis program, then to follow up with Starship being the vessel that might get mankind there. You know, these might sound like sci-fi to a lot of our audience, but SpaceX is building out a program where Starship, because it can carry 100 to 150 metric tons, can take the materials to space and to the surface of the moon needed to establish a base on the moon. And that might sound, as I say, scientific to you, but that is basically the principles to which the Artemis program is aiming.
Okay, Ed, I have the date for you. December 19th, 1972 was Apollo 17 the last time they went to the moon. I
wasn't around then, full disclosure.
I mean, I wasn't either, so it's okay. We're on the same page here. Neither you or I remember the last moon landing because we certainly weren't around. Okay, so let's say we have success here. The commercial viability of SpaceX, it increases whatever fold. What next? What does SpaceX look like as a standalone company? Is it an IPO? Is it something different? What is the future for them?
So in the last tender or secondaries round that SpaceX did, the company was valued about $180 billion. And what I've reported with colleagues is that 2024 is the year where revenue contribution from Starlink outpaces revenue contribution from the launch business. Remember, like, SpaceX makes money from government contracts and private contracts to carry stuff, payload, and human payload into orbit. But really, the money is in Starlink, right? This is a satellite constellation-based internet service where consumers pay a monthly subscription and also a one-time fee for a ground-based receiver. The hope of investors, and it's been downplayed by Elon Musk, is that the Starlink portion is spun off in an IPO. I've reported that the groundwork is underway. Starlink is being moved into its own separate legal entity, a standalone company, if you like. And there is some thinking that 2025 is possible when it comes to a Starlink spin-off. Musk has really downplayed that because, one, he has no problem raising capital from the private markets, but also, two, sorry, I'm just taking a look at my screen, and that is the booster, Super Heavy booster falling back down into the Gulf of Mexico. What they're going to try and do here, Danny, I'm sorry, I know I'm going on here.
No, please
what
do.
They're going to try and do is they're going to simulate the landing process of the Super Heavy booster, do the controlled burns to right it, put it the right way up, but they're still going to crash it into the Gulf of Mexico. They're not going to try and recover any of the hardware here. And final point on the space IPO, investors would love a piece. Elon Musk's basic point has been, I'm not going to spin off that Starlink unit until I have clear visibility on positive cash flow, which sounds a very sensible and prudent thing from Elon Musk, who is not often sensible nor prudent.
Yeah, and Ed, you know, I'll let you have a moment here just to kind of look at everything and make sure everything's going to plan with that rocket launch, because I know it's a lot to keep track of from, you know, my own amateur eyes. At least what we're seeing so far perhaps looks like it's gone to plan. I know you were saying that one piece was coming down there okay with crashing it into the Gulf of Mexico. So Ed, would be great to get an update from you just where we are at the moment. But secondary to that, I know each of the prior launches did end up with pieces of the Starship blowing up, and that led to an FAA investigation about their systems and environmental impact. So when it comes to regulatory impact, what could we see from this, whether it goes to plan or not?
So we are at the 8-minute mark. The Super Heavy booster, we've had confirmation, did splash down in the Gulf of Mexico. After the fact, there will be an investigation on how successful the process of simulating the booster landing was. What I think we're looking at now, and you hear cheers from the SpaceX staff, is that Starship's 6 own Raptor engines have now shut off. And what represents progress in this mission is that they will try later on to reignite the boosters on Starship, which has not ever been done before. What we're looking at in real time is just astonishing technological progress on what's happening. This is the 3rd attempt to get the Starship system into space. This last time what happened is that they got to an altitude of about 150 kilometers, traveling at a speed of 24,000 kilometers per hour, which is about 15,000 miles per hour. And there was an anomaly which
Let's get to your trading diary. What you need to be watching this week. We're going to get earnings from Adobe and Ulta Beauty later today. President Biden then will participate in a campaign event in Michigan. Tomorrow, we round out the week with the UMich Sentiment Survey, and we also get U.S. Empire manufacturing data. But the theme of this week has been inflation surprises to the upside. It happened with CPI on Tuesday. It happened today with PPI. The impact, yields moving higher by nearly 8 basis points across the curve. Equities turn, S&P 500 down by 0.4%. This was the countdown to the open. You're watching Bloomberg.
We're 30 minutes into the U.S. trading day, and it's Thursday, March 14th. And here are the top stories that we're following. Upside surprises. PPI ran hotter and retail sales weaker in the last major data ahead of the Fed's meeting next week, sending yields higher. And a mega merger in question. The Biden administration draws concerns about the pending Nippon Steel acquisition of U.S. Steel, which is extending losses in U.S. trading. And the CEO of the Bank of Ireland weighs in on the next move by the ECB as rate speculation ramps up. I'm Shonali Bassick in New York. Welcome to Bloomberg Markets. Let's take a look at those markets here really quickly here because we do have a lot of red on the screen here. We have the S&P 500 now down about 0.5%. The NASDAQ 100 seeing even bigger declines, about 0.6%. The Russell 2000 even more than that. Now down about 1.5% on the day, quickening its losses for the day here. And that's all on the back of higher yields. The 2-year yield just flying higher, now at above 4.67 on the day. That That is a 3 basis point move, but you have to remember just how far we have come. We were floating under 460 for a while there. We're going to dive in now to the economic data we had out this morning that is driving those yields higher. Joining us now is Bloomberg's Michael Makita. Bring us what we saw at the top of the hour.
Well, I'm going to start with a little of a nerd indicator, Shonali, and that is business inventories just out at the moment. And not a really good number. It's flat, 0.0 after a 0.3 increase the month before, and that is down from 0.4 it was originally reported as. And it suggests that the U.S. is not building inventories as much as people might have thought. There was a feeling that because GDP has shown inventories declining for the last some months, that we would see factories start to ramp up because if people are buying stuff, they're going to need stuff to buy. But they're not buying stuff either. You take a look at what happened with the retail sales report today, and it was disappointing to say the least. It had fallen significantly in January, and the rebound in February wasn't as great as anticipated, up 0.6%. The core of the retail sales, which is basically the retail control group that goes into GDP, was flat on the month after a 0.3 decline the month before. So all of this kind of tells you the economy is slowing down. But at the same time, prices are not slowing down. Another interruption to the inflation story as PPI comes in up 0.6% on the month. That is double what had been anticipated. And the core, super core rate, we'll call it, of ex-food, energy, and trade up 0.4. So those both went up on a year-over-year basis. It's difficult to for the Fed to make the case that we are continuing to see the kind of good news that they wanted to see before this March meeting.
Before this March meeting, it seems like we're getting a lot of conflicting data. On one hand, inflation that is upside surprising. I like the word we've been using all morning. And some of the data slowing down. How does that set us up not just for the conversation going into next week, but the dot plot, Mike?
Well, there are some Fed officials who, between meetings, have been talking about maybe fewer rate cuts this year. Raphael Bostic talking about the possibility that there might not be any. And so it would only take 2 members of the committee to move their dots up in order for us to move down from 3 cuts to maybe 2 cuts or even fewer. So there is a possibility that could happen if they think inflation is not where they want it to be. Now, it's preliminary. We've only had a month of really bad inflation news here, so we'll see if that's what they do next week, but it is now maybe a more live possibility than it was before.
Mike, we thank you so much for keeping an eye on all the data and putting it into perspective. We're going to get more insight now into markets and how they're being impacted by all this economic data. We are joined now by Manish Kabra. He is the head of U.S. equity strategy at SocGen. Manish, when you look at some softening data, particularly among the consumer, when you look at retail sales, do you start to worry about some sectors of the market that have been reaching new highs and breadth, finally hitting that market a little bit into recent weeks?
Yeah, I think it's a very fair question. So currently, I would say the breadth is all in large caps. You know, it's not in small cap. Equal weighted Russell is down for the year, but which goes into the thinking. I don't think market is excited about the real economic strength in the U.S. It's more focused on large cap, strong balance sheet. It is still focused on, surprisingly, Nasdaq. So I think the story for equities, especially in the U.S., as in it's all about Nasdaq more than.
So what about the Russell here? You have seen a lot of data really start to mess with the Russell. When you saw the inflation data, you did see that Russell 2000 take a hit. You are seeing it take a hit again today. What will finally bring love back into those small and mid caps? Or do you think that they have a real risk of being left out of this rally entirely? Manish, sorry, we are frozen with you there for a minute here. We do want to bring you a little bit more of how the market is reacting after that data at the top of the hour as well, because remember, we did see a quickening of losses. While we try to get Manish back here, we did see a quickening of losses in that Russell 2000 index, as we've been talking about with our guest here. And again, that is because we are having not only higher yields, but also worse than expected economic data when you look at the consumer front in particular. What is more impacted than other areas in an environment like this, and we're seeing anything that's not that big tech sector being left out of that love. Now, while we're waiting here, let's go to our own reporter, Emily Grafeo, to see what's moving in markets now. Emily, thank you for joining us. What are you taking a look at?
Well, you're talking about the consumer, and I'm looking at Dollar General. They have over 20,000 storefront locations, and they've actually been able to kind of turn their business around after consumers were really pulling back from purchasing pretty much anything during, this period of higher inflation, higher interest rates. But their earnings were pretty good. Fourth quarter comps came in at 0.7% versus estimates of a drop of about 1%. The same store sales forecast beat, and this is compared to their competitor Dollar Tree, because just yesterday we saw Dollar Tree fall about 14%. They plan to close about 1,000 stores, and now we have Dollar General saying that they plan to slow store openings, but they're still going to be opening about 800 stores, which sounds pretty good to me for Dollar General. So interesting kind of comparison between these two very consumer-focused companies this morning.
What else is moving here?
So we also have Fisker. That stock is down. Last time I checked, it was down more than 30%. The Wall Street Journal reported that the company has hired advisors to assist with a possible bankruptcy filing. So we're still waiting for more information on this, but we do know that about 2 weeks ago, Bloomberg had reported that the electric vehicle company was in talks with Nissan for a lifeline for potential liquidity challenges. Their most recent earnings report was weaker than expected. That was a few weeks ago. And then they also said that they're going to be they were experiencing production issues, technical glitches. This is an interesting company because it was one of the kind of high-flying SPACs that went public via a special purpose acquisition company back during the pandemic, and now the share price has fallen almost 100% since then for
It's
Fisker.
amazing. Fisker shares now down about 50%, the most ever, and also at the lowest ever as well. It's interesting. What else are you keeping an eye on here? I do have some questions about how we're seeing the tone shift among investors.
Yeah, I mean, UiPath was an interesting one because that stock has kind of been moving around all morning. Most metrics on their earnings front actually beat. Now the stock is down 4%, but the earnings were pretty good. The full year revenue forecast beat, fourth quarter revenue, EPS profit, all these metrics beating. They also saw a number of Wall Street analysts upgrading their price targets, JP Morgan, Evercore, and yet the stock is down 5%. Perhaps it's that the first quarter forecast missed for revenue. They see revenue at $330 million to $335 versus estimates of $347. But I was looking through the earnings report for this automation software company. They deal with generative AI. I was really looking for what was driving the stock lower, and the street, at least the analyst notes, and the actual earnings report doesn't really speak to that just yet. So we'll have to look more into that.
A little bit of negative sentiment out there today. Thank you so much, Emily Grafeo, for sticking with us on all the stock movers that are underneath the surface today, particularly on a down day in the market. Now stick with us. Coming up, we're going to talk about Saudi Arabia in talks to add top banks from Wall Street to its record Aramco share sale. We're going to have the details on that deal next. This is Bloomberg. Now, Saudi Arabia is powering on with a record secondary share sale in oil giant Aramco. Now, reports say the Saudis plan to hire JP Morgan as one of the main underwriters to the offering. Bank of America and Morgan Stanley are also contending for lead roles on the deal. It could raise as much as $20 billion. Now, joining us with more is Bloomberg's Matthew Martin in Riyadh. Matthew, put this share sale into perspective. Why now, and how competitive is it for these banks to get on this deal?
Hi, yeah, well, look, as you say, it's an intensely competitive process. If you remember back in 2019 when they first did the IPO of Aramco, which raised around $30 billion, making it the biggest IPO deal in history. So it's an intensely competitive process for these banks. It's not something that proved to be particularly remunerative for them, though. The fees on it were very, very low, but the pressure was on to get on it really for league table and credentials purposes, rather than because it's going to raise a huge amount for the investment banks involved in the process. And the government, the Saudi government, is now, particularly keen on trying to do this, because as we get further through this plan that Crown Prince Mohammed bin Salman has to invest in diversifying the economy and invest internationally as well into creating the sovereign wealth fund here as making it one of the world's biggest, the pressure is on increasingly to find sources of being able to fund that. And Aramco has traditionally always been the cash cow for the Saudi government, and that remains to be so. It's just now being used in different ways. Now the equity offering is being done to try and get the cash up front so that it can be used to accelerate investment plans elsewhere around the country and internationally as well.
Now, it comes 4 years after Saudi Arabia raised about $30 billion in the IPO. That was the world's largest stock sale at that time. Not surprisingly here, Moelis & Company, part of the team here, the financial advisor to pick the underwriters. We know Ken Moelis very close here to the kingdom itself. The fee structure. Talk to us about the fee structure and how this is unique for a deal like this.
Well, the investment banks, the big global investment banks, until around 2015-16, really had very, very small presence in Saudi Arabia. It was a very closed market. Now that it's opening up, we're seeing a lot of other offerings taking place locally, and as well as obviously these big things like Aramco. It's starting to attract more and more of them in, like Moelis, as you say, like the JP Morgans and Bank of Americas of the world, looking to staff up and build their presence here. The challenge has been that these deals are often done on very, very thin fees in comparison to what you might get if you were doing a similar sized IPO in the US or Europe or even Asia as well. So the challenge out of doing these deals is trying to find ways to make sure that it still ends up being, you still get your payday out of it. And so the banks are keen to show their relationships with the kingdom, show their relationships with the government, in the hope that whilst you probably don't make a huge amount of money on these big deals like this, you can then use it as ways to get other mandates, whether this is working for doing the M&A mandates for the Sovereign Wealth Fund, the PAF, or Aramco's M&A mandates. These are all institutions that are all very closely linked. There's a big crossover. The governor of the PIF, Yasser Al-Rumayyan, is also the chairman of Aramco. So he's a key client for these banks who they want to please, so that they can get roles on other deals, which hopefully will end up giving them a bigger fee payday in the future.
Matthew Martin, we thank you for all the details. Certainly a tense moment for the global banking industry to get on that mega deal. Now we're going to get back to markets with Manish Kabra, head of U.S. equity strategy at SocGen. Manish, so nice to have you back. We started here to talk about the IPO market, or the listing market rather, because there's an exuberance that has been underpinning these markets, enough at least for new stock to hit the tape. How do you feel about that exuberance?
Yeah, but it's a fair point. Is it exuberance or is it optimism, right? And I think there's a fine line of difference between those two. And I think watching, the markets, the underneath of markets, the global M&A transaction, they have barely picked up. So usually one of the first signs that happens here in exuberance is, start of IPOs, moving to M&A, moving to even leveraged buyouts. I think that's the natural progress of the bull market. So far I would say this is all everything feels irrational optimism rather than irrational exuberance.
How do you feel about where that exuberance or optimism rather ends? We were talking just before we last left off about where the Russell 2000 stands and whether there's a possibility that these stocks get left out of the rally. How do you feel?
There's a huge difference of the large cap. They have the best leverage. They have the best debt profile. As against small caps, they still have massive refinancing to go through. So I would say the ideal best scenarios where we would go out and say to everyone buy small caps in the U.S. is when yield curve goes to 100 basis points or higher. So at the moment, I would say the Fed, the inflation, and then we saw the PPI today. Market is just evaluating whether the optimism, excitement, and more than optimism, the excitement that we had in back end of last year, whether that's going to persist. And then for us, non-recessionary rate cuts are more rate adjustments, rather than rate cutting cycle. So yeah, and then to give a very long story short answer, you need yield curve, very strongly positive to say small caps will perform, in line with what large caps are doing.
It's interesting as well when you're thinking about the interest rate story here and the fact that yields are now, or on the 2-year at least, up above 467 and that drift higher we've seen in recent days. What kinds of equities are most impacted in that environment that does not necessarily see 3, 4, 5 rate cuts this year as investors had expected at the end of last year, early this year?
Yeah, so as in usually when these short-term rates are rising, and if they are rising with good growth, good inflation, it's not a problem. As in the main thing that we are watching is the fixed income volatility, which is the MOVE index. If it's staying stable, if it's going lower, as in our call is, bond market will be very boring. It will be flat range, very tight range. 10-year bond deals. If we stay at that backdrop, the only thing we need is the MOVE index, the volatility in fixed income not to go up. As against, we are expecting the vol to come down and a catch up, from the MOVE index towards where all the different asset classes are.
One other area I'm interested to, given the run-up that we've seen last year, early this year, is semiconductors, right? If you were excited about the movement upward in the large cap technology stocks, you were much more excited about what you saw in anything even driven higher by the NVIDIA boom. How do you think that those equities continue to fare?
So I have been bullish NASDAQ. I think the tech story in the U.S., it has more room. And then my message is run with the bulls, for NASDAQ and, semiconductor stocks, because, ultimately what we are watching for is, the CapEx cycle, for AI, for different semiconductor, that needs to slow down. And that only slows down when the earnings growth rate starts slowing down, for all the large cap tech. So my take is, as in, we are expecting slowdown in growth, but it's more backloaded as against, first half, we will see 40% earnings growth for NASDAQ. And that's what market is going to look for, as in it's going to buy, any weaknesses that happens in NASDAQ during the first half.
It's kind of like you have to run with the bulls or get run over these days, isn't it, Manish? If you think about areas that you're willing to start to sell a little bit, where do you look?
And then where I think the profit-taking elements should be there, as in we are still conscious of bond proxy parts of the market, as in that's the part where I think for us we are at lower end of the trading range for US 10-year bond yields, and what that means is if we have floor on to what level bond yields will go lower in this cycle, I think anything which is bond proxy, we are just saying avoid it and start selling if you have any. Apart from that, short duration, we like short duration. We have a lot of things to like at this point rather than disliking at this point.
And when you're talking to clients as well, if they think about how to hedge against this rally without getting burned, right, getting run over by those bulls, how do they protect themselves?
As in the, in terms of best protection, it has to be anything linked to that is exposed to a lot of leverage. As in that's, despite credit conditions getting easier, credit spreads coming down substantially, we have seen, material outperformance within the credit market of the leverage part of the credit market. As in, if anyone wants to protect, I would say it's still, focused on where the credit market is and protecting on that side more than, protecting on growth, more than protecting on, if there's a big, Chinese disinflation that's taking place. I don't think we are worried about that part or growth part of the equation.
Manish Kabra of SocGen talking us through a very complicated market that we are experiencing today ahead of all of that economic data and a big Fed meeting next week. Now, still ahead, we're going to take a look at companies making the most buzz on social media today on Social Climbers. That's up next. This is Bloomberg. Time now for Social Climbers, a look at the stocks making waves on social media this morning. And first up, Adidas making the social rounds. The German sportswear giant is now getting hit by the fallout from its costly breakup with the rapper formerly known as Kanye West. Adidas is trying to work through the high inventories of unsold sneakers. And next, Under Armour founder Kevin Plank is returning as the company's CEO beginning in April. And he replaces Stephanie Linnartz, who was in the role for just a little over a year. And finally, the online brokerage platform Robinhood reporting positive operating data in February that includes rising assets under custody and surging trading volume. You can follow all of the latest company buzz on TREN Go on your Bloomberg terminal. Now, SpaceX launched its colossal Starship rocket on its third major test flight just about an hour ago. Bloomberg's Ed Ludlow joins us now with the latest. Ed, what are you keeping an eye on here?
The truth is that we don't know the status of Starship. We lost the connection or camera feed at an altitude of about 65 kilometers, so below the Kármán line. It was traveling at 25,000 kilometers per hour, which back of the napkin math is about 15,000 miles per hour. What was astonishing is as Starship re-entered Earth's atmosphere and came below an altitude of 100 kilometers an hour, the signal was maintained for an incredibly long period of time. It was engulfed by flame, or actually more technically plasma. And the reason that SpaceX was able to maintain such a strong camera connection is because Starlink. There is a Starlink unit actually locally on board Starship. And when coming even from a higher altitude in space down to Earth's atmosphere, the Starship's able to maintain constant connection with different Starlink satellites, which allows SpaceX to give us that camera feed. But the blanket statement, the story here, is that SpaceX has just sent its Starship system further and at higher speed than it's ever done before. And from a pure technology perspective, this will be a huge success. One small update, there was a kind of uncontrolled crash of the booster into the Gulf of Mexico. They were going to try and simulate a landing up to the point it hit the water, but I think they kind of lost control. There will be a post-mortem on that in the coming days.
Well, let's also talk about just the significance of this for Elon Musk, for SpaceX itself. You know, we've been reporting that this is one small step of his broader goal of eventually taking humans to Mars. So what does today mean?
Well, today this sounds flippant, but it's a test of rocket science. There are so many things that they had to prove. For example, Starship's heat shield, right? So I hope we can get those pictures for the audience as soon as we can, but as it re-enters Earth's atmosphere, it becomes engulfed with what looks like flame, right? Pinky purple flame, that plasma. But falling at hypersonic speeds, it showed us that the heat shield that SpaceX designed, which is 18,000 hexagonal ceramic tiles, worked. You know, they've not been able to test before. Well, what happens if you put Starship into space and then let it fall at 25,000 kilometers an hour, 15,000 miles an hour, and then reach subsonic speed? The point really here is that we don't know what happens after that. So the science, the technology works, and the whole future of this company in the near term to deploy greater volumes of its Starlink satellites to build out a more comprehensive constellation that will allow more people around the world to use Starlink internet. And longer term, if a human being is ever going to get on board Starship, this is evidence that they're making progress for that to be a reality, right? To make it safe. It has to be absolutely automated and fully functional before any human, I imagine, would get on board.
Maybe while we wait for more news of how the ship is faring right now, how do you think through the drama of this moment?
For what it's worth, not that it matters what I think, that in my career as a technology journalist, that was probably the most exciting 15 minutes I've ever had. And for many people watching, they will as well. You know, there are no humans on board this time around, but just the scale of Starship, the fact that it can carry a payload of up to 150 metric tons, the sheer thrust power of the Super Heavy booster and the 33 Raptor engines that are involved in that, the hot separation, you know, this is at the cutting edge of what mankind's been able to do with its space technology. And the main point is that until this point, all of the things that Elon Musk says about the future are quite abstract, that mankind will be an interplanetary species, that we will be able to get internet anywhere in the world using a $500 ground receiver from Starlink. By making evidence that the system is improving and that Starship will soon arrive, it kind of adds some weight behind those things, right? And no matter how sci-fi you think it is, it's technology in action, and that's cool.
Ed, let's take a big step back and walk us through what to expect out of the logistics here.
Well, I think that there's a lot we don't know. For example, the altimeter on the SpaceX feed is still showing that Starship is at 65 kilometers altitude. I think that's highly unlikely. You know, the chances are that something has happened. We don't know for certain, though. So there will be an investigation on what actually did or didn't happen in the process. I think that the authorities will also have a very close look. Following Starship Test 1 and 2, the FAA and environmental agencies all took a look at the impact of what were essentially explosions locally around the Texas basin of Boca Chica, but also that, right, in this instance, the booster lands in the Gulf of Mexico. We don't know where Starship is, the spacecraft, but the aim was to land it in the Indian Ocean. All of that takes coordination across multiple government agencies and jurisdictions. They'll look into that. And then, you know, as with all Elon Musk-backed companies, the question is, when's the next one? You know, how quickly can they get into a cadence of doing this? Because, you know, we always say on this network when we show a Falcon 9 launch, the rocket system that SpaceX launches most regularly, that it's become routine. But it has become routine, and the reason that's the case is SpaceX is able to launch with an incredible cadence. A part of the progress that analysts and space industry veterans want to see with Starship is that SpaceX can launch the system with regularity. So this is very exciting, but it means nothing if it doesn't happen again soon, and so on and so forth.
How do you think about this particular landing relative to the last two, Ed? If there is a moment where it doesn't go exactly as planned, how do things end up playing out?
As I said, the simple matter here, the headline is that Starship went further in terms of distance at higher altitude and at higher speed than they have previously achieved. They were always going to, they were not going to recover either the Super Heavy booster or the Starship spacecraft, but they were trying to simulate a landing in both cases. They probably haven't achieved that. What happens with Starship, and we won't know for a number of days, is when it goes from hypersonic to hypersonic speeds, it has a terminal velocity of about 200 miles an hour, where it does the belly flop, and it tries to right-size itself using a gimbal system, where the flaps and using aerodynamics, but also the positioning of the Raptor engines right-sizes it, and it's probably likely that they didn't achieve it that far. It seems like, yeah, okay, so SpaceX has told us, red headline, SpaceX loses Starship during re-entry, cutting mission short. Red headline, that's a little bit harsh to me. I think they got pretty close.
Well, that's exactly what I wanted to take out. This is now breaking news. SpaceX now confirming that they have lost the Starship during re-entry, the mission cut short. Now, what does this all mean, now that it's confirmed?
Yeah. So SpaceX's position on this, if you go back to whatever it was my local time this morning, 6 a.m., that even getting off the launch pad would be success. The payload in this case is not a satellite. It is not a human being. It's the data that the Starship system is generating and feeding back to SpaceX. The fact that they were able to launch the combined system, the booster and the spacecraft, get it to the orbital height that they did, the altitude they did, they had a successful hot separation in that process. Starship traveled on its telemetry over to the Indian Ocean, and then it started to re-enter Earth's atmosphere. The camera feed was maintained because of the onboard Starlink, and the signal was lost at 65 kilometers altitude. Sorry, Shonali, for some reason the SpaceX feed, they're all holding pies, and I'm trying to work out what on earth they're trying to demonstrate or what analogy they're going with here, such as the joy of covering space. But up until that point, everything was unprecedented, right? So they have a high volume of data.
That's what's going on over there.
Right. I don't think anyone at the best of times kind of knows what's in Elon Musk's head. But yeah, that's my best interpretation.
Ed, thank you so very much for sticking with us through another historic moment for SpaceX. We'll bring you updates as we know them. Now let's take a quick check on the market here. After all that excitement here, we do still have a lot of red on the screen. The S&P 500 still down more than 0.1%, and the Russell 2000 still down almost 1.5% on the day. We are seeing some turns in the NASDAQ, flipping green for a moment here, but roughly flat on the day. The 2-year yield holding steady about 3 basis points higher at about 4.67 on the day. And remember, that is after some critical economic data. The last big set of data releases before that massive Fed meeting next week. Now, from the U.S. central bank to across the world, the Greek central bank says that the ECB must cut rates twice before the summer break. But the ECB left policy unchanged last month for a 4th consecutive meeting, with officials converging around June as the appropriate juncture to start easing. We're going to talk much more about this view now with Bank of Ireland CEO Myles O'Grady, who has the perfect view of this conundrum. How do you see the dynamic going here? If they don't cut enough, what would be the impact into the broader financial system?
Yes, indeed, and good morning. Just to say, Bank of Ireland, we're 241 years old, 50 in the United States, so it's really good to be here this week. We're meeting our investors and also our corporate clients. Yeah, I mean, we know that inflation has come down. A year ago it was 8.6% in the Eurozone, now closer to under 3%, and likely to get to that long-term target of being closer to 2% over the next 12 to 18 months. That's going to impact clearly monetary policy, and we can expect rates to come down, I think, over the course of this year. And certainly that's a positive generally to get to a more normalized rate environment, certainly for Bank of Ireland.
Now, how much does it matter to you how much they cut?
Well, it is important because there is, I guess, much of our earnings, our interest income is protected from our hedging strategies. That's really important. What's important from my perspective as CEO that we get visibility on what a normalized rate is out over the next 2 to 3, 4 years. That's almost more important than the rate cut. But we assume our models, if I think about Bank of Ireland is generating returns last year of 17.3%. We've got a target of 15% out to 25. That is supported by a rate environment of between 2 and 3%. It's that range that is the sweet spot for Bank of Ireland.
Well, do you think that it gets there?
I do, yeah. I mean, if you look at the progression of inflation coming down, we'll see, there's views as to whether the ECB will move on rates in April, possibly more likely June. But I think we can begin to see that rate coming down.
Now, if you believe that rates might be somewhat higher for a little longer, do you have any worries as a CEO here that perhaps the economy softens too drastically, too quickly as well?
Well, there's certainly, there is a risk in the Eurozone generally in relation to growth, and that's clearly informed by the rate environment. From an Ireland perspective, as a CEO of Bank of Ireland, my focus is on our home market. 76% of our earnings come from Ireland. Ireland's story is one of, first of all, banking consolidation, so that's a positive factor for the Bank of Ireland business model, supporting those customers. But also, Ireland will grow, and we expect economic growth in Ireland to be between 3 and 4% out over the next number of years. So that's very supportive. Again, back to that point around our targets, that 15% return, the sustainability of that return is in good shape.
And from your perspective, what would be the biggest driver of that growth?
Yeah, certainly in Ireland, we have a number of very positive factors. Last year, our balance sheet, our Irish balance sheet grew by 23%. Large increase year on year, very much supported by the mortgage market. Other areas of growth, so our business income was up strongly, 8% increase in customer numbers. That's very strong. And our wealth business, a very important part of our business, our wealth assets grew by 18% last year. That level of progression last year, and we see that through over the next few years, is going to be supportive of our earnings capability.
I'm glad you mentioned the mortgage market. There are other parts of the property market that many investors around the world are starting to get very worried about. How do you view this dynamic, especially if rates stay a little higher for a little longer? Do you think that there will be a lot more stress?
Well, we know that commercial real estate is under a degree of pressure right now. We understand the factors for that. We've got an increasing rate environment that's not translating into yields. We've got changing behaviors in relation to colleagues going back to the office. There are factors. My view is that quality commercial real estate, office space that is in either new or has been refurbished and is in good locations, I am optimistic and positive for that part of the market. Areas that aren't in such good locations or not such good condition, they're vulnerable. The other part, of course, from an Irish perspective on commercial real estate is home building. And we know there's huge demand. Last year, Ireland produced 34,000 homes. We know there's demand of about 50,000. So, as CEO of Bank of Ireland, I'm very happy to support that part of commercial real estate to bring new homes to the market.
What is your conversation like with other lenders, other private capital providers right now?
Well, it is interesting. So there's what is clear is that there is plenty of capital out there to put into Ireland. In fact, in many ways, when this week meeting many of my investors in Bank of Ireland, because Bank of Ireland, we call ourselves a national champion bank in Ireland. That's because we've got a full coverage of financial services. In many ways, investing in Bank of Ireland is a way of investing in the Irish economy as well. And on that basis, there is strong support for Ireland.
Myles, we thank you so much for your time here. Also, happy St. Patrick's Day
this
weekend.
Much.
That was
That's my last time as well.
In Dublin. I had a great time there myself.
Oh, very good to hear. Good to hear. Thank you very much.
Thank you so much. And while we're waiting, we're going to check now on the markets with Abigail Doolittle.
Well, Sonali, we are looking at markets here for the NASDAQ 100 that are down on the day, down 1.4% over the last 5 days, I should say, down 4 of those last 5 days, but down earlier, now trying to make a little bit of a rebound on the day. The S&P 500, the NASDAQ, the last time I saw the daily price down just slightly. In fact, let's take a look at that S&P 500 because we will see here whether it's higher or slightly lower, still slightly lower, down about 0.2%. And of course, one reason for the pressure is that hotter than expected expected, warmer than expected PPI coming in 0.4% higher than expected, suggesting that inflation is a little bit more sticky than some would like. So you have that 10-year yield up 9 basis points after backing up 30 or 40 basis points in the last month. You now are looking at a 10-year yield closer to 4.30, pressuring stocks, but really pressuring technology stocks. Take a look at the stocks down 0.9%. NVIDIA down another day in a row, down 2.8%. That mega rally out of the October 2023 lows up more than 600%, out of the 2022 lows up more than 800%, giving some of the back. In fact, let's take a look at the technicals on NVIDIA, because it suggests that there could be some more weakness ahead for this stock, and then does that move into the markets overall? So what you can see here is a beautiful uptrend, but you can also see incredible extension, 95% above the 200-day moving average. That tells you this stock has basically doubled this year. The RSI, on the other hand, coming out of overbought territory. So these recent highs, Sonali, they're on less enthusiastic buying power. That's a bearish divergence. It suggests we could see some more consolidation ahead.
Bloomberg's Abigail Doolittle, we thank you so much for keeping an eye on the market and everything moving under it. Now, coming up, we'll hear from Elizabeth Economy, Senior Fellow at the Hoover Institution at Stanford University, about investor concerns in China. This is Bloomberg. Now it's time for Wall Street Week Daily. Yesterday, Bloomberg's David Weston sat down with Elizabeth Economy, Senior Fellow at the Hoover Institution at Stanford University, and he asked her about President Xi Jinping's plans for economic growth.
It's about investing in technology, right, and advanced manufacturing. And so when Xi Jinping talks about, marshaling the, new productive forces, right, he's very explicit. It's about space commerce. It's about EVs. It's about AI. There's a whole AI Plus initiative, right? They're going to integrate AI through all the sectors of the economy. It's moving away from the traditional investment in the property sector, which, as everybody knows, has, been quite weak and sort of, oversubscribed, into advanced manufacturing, into innovation. So that's how he's going to grow the economy. It's relying on those coastal provinces where you do have the innovation, you do have an incredible manufacturing ecosystem, and leaving the rest of the country really to suffer through.
So until now, I thought that the Chinese theory was to replace export growth with personal consumption domestically. As I listen to you, that doesn't sound like growing a lot of personal consumption within China.
No, there were no moves made at this NPC to do that, right? And what we would have looked for, is something to do with wages, because don't forget, back in the summer, the government cut the wages of civil servants, some of them by a third, right? So I know professors personally who are taking on a second and a third job just to make ends meet at this point, right? People don't have income. They're not out there spending. And they also haven't done anything to build up their social welfare net, something they've been talking about for decades, right? Do something for healthcare, do something for education, so that people feel comfortable spending, because they know they don't have to spend their personal wealth on those things. So we didn't see any of that happening. Anything that we would suggest is sort of targeted to boost consumer spending.
You talk about people feeling comfortable spending. There's a confidence issue, we believe, within China itself. There's also a confidence issue in terms of foreign investors going in. As you know better than I, foreign direct investment is really fallen substantially. Where do they stand on that? And is that an issue for President Xi? Is he concerned about that issue?
Yeah. So it's interesting. I was in China back in August and had the opportunity to meet with a number of senior economic officials. I went with Secretary Raimondo, and we heard consistently all the way down from the premier down to the Minister of Commerce, they welcome foreign investment. They want U.S. business to be there, and they're all holding meetings with international business, telling them that we welcome you. But there are no steps, there are no concrete steps being taken to demonstrate that welcome. And so what you have is the security apparatus in China taking all sorts of measures that in fact are signaling the opposite. And so I think there's really a battle between the economic reformers, the few that still remain, and the security apparatus. And it's really the security apparatus that Xi Jinping has empowered. And so I think in that battle, it's clear that the security side of things is winning.
Well, I'm curious about the battle because there's a sense that President Xi has just really concentrated more and more power into himself, frankly, and in Beijing. So is there room for dissension right now in terms of economic policy within China?
I think there is room for debate. In fact, one of the things that we've heard is that the reason that there hasn't been a third plenum, which should have happened this fall, and that's typically when China lays out their plan for economics for the next 5 years, right? This is the NPC is a 1-year plan. This would be a 5-year plan. The reason that they haven't had it is because they can't agree. And so, if that's the case, that suggests there still is a lot of debate. And I've heard from friends of mine that there's still some room for discussion and debate. They can't resolve certain issues. But again, it's clear that for the time being, the security apparatus is in control.
Whatever the shape of the Chinese economy, it is the second largest in the world. And it's very different, it strikes me, than when we were dealing with the Soviet Union back in the 60s and 70s. We could sort of avoid that economically. China, the West cannot avoid China, dealing with China. So what is the U.S. and Western policy economically toward China right now?
I mean, I think, there are many debates within the United States alone, but also among our European and Asian allies about how do we strike the right balance. And I think, the code word, of course, is de-risking, right? And what does that mean and how do we look at that? And I think there are a number of ways in which, we in the United States are de-risking. I think first, there's the issue of de-risking around national security. And that's the most important thing, right? We want to make sure that whatever it is that we're selling to China or any investing that we're doing there or any investments that they're making here, we are not doing anything that is helping them technologically with products that are going to potentially undermine our own national security. Right? So I think that's number one. Then there's de-risking around our supply chains. And I think that's, basically that happened because of COVID, right? COVID was our wake-up call. When we couldn't get, personal protective equipment, the PPE that we needed, right? It was all located in China, all the manufacturing of the gloves and the masks and everything else, right? We realized that's, we can't afford to have that kind of dependence on any one source. And so, now the big issue, of course, is semiconductors. And that actually isn't even about China. That's about Taiwan, right? Our reliance on Taiwan for advanced semiconductors. So it's about talking with our businesses, about businesses themselves, understanding, right, the risks of an overdependence on China or any other one, sort of one source for critical supply.
That was Elizabeth Economy, Senior Fellow at the Hoover Institution at Stanford University. And tomorrow on Wall Street Week Daily, we'll be joined by Ken Rogoff. He's a Harvard professor of economics. You're not going to want to miss that conversation. This is Bloomberg.